This is Jay Martin.
All right, welcome to the Jay Martin Show, and I'm sitting down with Luke Gromen once again. Luke, it's great to see you, and thanks so much for making the time.
Thanks for having me on, Jay. It's great to talk to you again.
Well, I'm looking forward to this because I want to go a whole bunch of different directions. One place I wanted to start, though, is it seems like media at this point, Luke, mainstream media, has reached consensus about what might happen to the European Union this winter, right? And we're looking at these like energy forecasts in Germany, predicting like 3,000% increase over 5 years, and what could be called a market failure, in street terms, hyperinflation and the collapse of industry. In your recent letter, you speculated that this is probably going to occur unless something changes, and you're not absolutely convinced that nothing will change, right? So first of all, walk me through that thesis a little bit if you can, and why what could occur this winter could lead to global rising inflation. And secondly, why that path might not occur and what could change to prevent it.
Sure. So we've all seen what's happening with energy prices in Europe as a result of various sanctions and disruptions of Russia invasion of Ukraine. If nothing changes, you'll see the energy price increases that have already occurred. You're already seeing it shut down industry downstream. So a notable percentage of the aluminum smelting industry in Europe is shut down. Energy costs are too high. I think zinc the other day. There have been discussion throughout the last 3 to 4 months about the implications for ammonium production, which is of course critical for food production. And so it was, I thought, perhaps most starkly framed by Zoltan Pozsar last week when he said $2 trillion in German value in industry rests on $20 billion worth of Russian gas. And so as that gets taken away, you have this cascading effect. So to me, there's a few possible outcomes, and we can talk about how to handicap those. I think where consensus is at this point is that basically this thing crashes into the ground at 400 miles an hour. And if that happens, if we get this energy inflation, the disruption to industry, you're going to renew supply chain disruptions around the world. We're going to go right back to earlier this year, late last year, where you had these severe supply chain disruptions. That's going to reintroduce inflation, in my view, at the CPI level around the world. And that then puts more pressure on the Fed, other central bankers to tighten further. The problem, of course, in my view, is that Western sovereign debt in particular, I'd argue probably China's in this camp as well, the debt levels are so high that they can't raise rates much more without bankrupting the sovereign, or the central bank stepping in to print the money, print the difference. So you're getting to this very, people say, well, how many more times can they kick the can down the road? You're getting to the point where they can't kick it down the road. It's going to be this moment of either you let inflation go, you print the money, or you don't raise rates to address the inflation, or the whole system sort of comes unhinged in a chaotic manner. That's not, neither one's a good outcome. And I'd like to think that there are leaders in Europe that are thinking of potential alternatives. Thus far, I've not been impressed that there are. They seem to think, being cold and windmills and solar panels are going to save them. And if that's the case, I would if I was in Europe, I'd be trying to get to the United States for the winter.
Right. Yeah.
The thing that I think nobody's too strong a term, but I think there are other options. And the other option is ultimately either basically change geopolitical alliances, which is to say, go back to Putin, agree to pay in whatever currency that he's demanding, and sign a long-term LNG deal, gas deal, energy deal, whatever. Or, and this is a little bit of part and parcel of the same thing, pay in a better currency, right? Offer a sweetener, which is, look, if you offer, a 5 grams of gold valued at $3,000 an ounce, or valued at market if you want, or you can value it above market. But the point is that then you could say, the Eurozone you could do two things. I mean, if I was in their shoes, this is what I would do: is I'd say, okay, Russia, we will pay you whatever, 20 euro per barrel for oil, equivalent for your gas and for your oil. And we will give you whatever, 5 grams of gold or 100 grams of gold valued at 3,000, practical terms. It's probably, 1 to 5 grams of gold, whatever,
Sure.
valued at $3,000 per ounce, well above the market. Because now if I'm Europe, I get two things. Number one, I can get my energy bill down and get my industry back on its feet. And number two, I can source all the gold I want at $3,000 an ounce because I can show up in London and New York and buy it for $1,750 an ounce and make money on the spread. So as a practical matter, of course, you don't need to move it up to 3,000. It can be, 1,800 when it's at, say, put $50 over market.
Yeah,
whatever,
add a little bit
whatever
of
the
margin
case is.
onto it.
Add
Yeah.
a little bit of margin, whatever the case is. That's a way you could do it. Now, that is fraught with massive geopolitical, currency market, reserve currency system, all kinds of macro issues. It's not that clean. That's a very simplistic view. But my point in raising this is just that at a time when consensus, at least as far as I can tell, is overwhelmingly in favor of the Eurozone's going to break up and people are going to freeze and starve to death this winter in Europe. Normally when consensus is on some catastrophic outcome,
Right.
usually something else happens, right? Like, I mean, I remember sitting in a client's office in March of 2009 and, the world was ending. And this portfolio manager, I'll never forget, said to me, he goes, "Look, Luke, here's how it's going to go. This goes on for another 2 months. I'm not going to have a job. You're not going to have a job. No one's going to have a job. We're all going to have much bigger fish to fry. So let's start thinking about what could change." And like literally a week later, the Fed came out, printed $1 trillion and started buying treasuries, right? And away
Right.
we went. So
Yeah.
that's sort of the genesis for my thought process on this. Is not so much, hey, here's what's going to happen. But if you start thinking about other options other than sort of the world ending, which is usually a pretty good bet, right? The start thinking about something other than the world ending, then let's see what else develops.
So if I'm understanding you correctly, idea one is that Europe can't prevent their energy crisis, can no longer afford to keep their industry running, therefore produce the goods that the rest of the world needs. If they can't afford to manufacture anything, those things don't make it to the global market. That inspires higher global inflation everywhere. And we go back to these massive supply chain bottlenecks because products aren't making it out of the European Union. And that seems to be consensus. I agree that that's where we're going to end up. But I'm with you that more likely what will occur is that citizens will get vocal and say it's freezing and we don't have jobs. What's in it for us to stick with our Western alliance? Why are we still doing this? It's no longer in our best interests. We have oil, gas, and food in Russia. Let's strike a deal here, right? And so that's when you get sort of a redrawing of the board. Germany, I guess that makes sense. There's countries like Norway, I think they import like 99% of their gas from Russia, and countries like Italy, like 25%. Like they don't have a lot of other options. You have to assume that's where they're going to go as soon as it gets cold. What I want to understand a little bit more, Luke, is why would Russia accept the premium priced gold in exchange for oil when market value of an ounce of gold is what market value of an ounce of gold is?
Ultimately, it would be a good deal for Russia because they're sitting on a pile of whatever it is, 2,300 tons of gold or whatever, right? So they will have used their oil and gas to revalue their gold reserves up massively. And they could more than fully replace the FX reserves that were frozen 6 months ago by the West. Because they would immediately, if the value of gold is, again, I'm using 3,000 just for easy math, it's literally the mark to market of their FX reserves is up enormously. The other thing that would do is $3,000 per ounce is a little bit north of where Russia would need to run a complete gold standard. which would basically make the ruble unsinkable at that point. And then they could lower interest rates, they could open up the capital account, and all of a sudden, it's going to be a very strong currency without any capital controls on it. And that, I think, is another thing that they might be thinking about possibly. Certainly in terms of just that flexibility. But I think the short version is it would revalue their FX reserves. It would allow them to completely revalue replenish their FX reserves using their oil and gas.
Right. Now, if you were to think through the countries that would be most likely to rethink their alliances due to demand for natural resources, mainly food and energy, the argument's quite strong from Russia, right? We've got cheap food and energy. And what does the West have for you? Sanctions, right? That haven't really worked thus far. Any other countries, Luke, strike you as likely to flip and essentially change teams from their Western alliance to some sort of an Eastern or BRICS bloc?
Yeah, for me, the changing of alliance is really just about, I was just having a conversation with someone about this. Like, well, Germany's not going to leave NATO. There's no change in alliance coming. Okay. But then in the next sentence, they say buying Russian gas is a threat to national security. They say, and I said, well, whose national security? Germany's national security or the United States' national security? And they don't really answer. But my retort then is, well, if it's a threat to national security, then how is Germany continuing to buy Russian gas not a de facto alliance? If Russia, if China, if any of these countries buying Russian gas is a threat to U.S. national security, in my view, mostly, then they are an alliance of sorts. It's an economic alliance of sorts. It's why the U.S. doesn't like it. So I don't, just to be clear, I don't think NATO is going to break up, but I do think we're going to wake up in 6 months and NATO, critical parts of NATO, and probably the Japanese are going to be buying Russian gas, and they might be buying it, at least some of it, in their own currency, not in dollars, out of realpolitik. And that's where I think, when I say I think you're going to see some alliances shift, that's what I think. Now, I think there's two ways of thinking about that, setting aside the nitty-gritty of what politician likes this nationality and all that sort of intra-European stuff, which I have no knowledge of, view of. I would say I'd look at it two ways. Number one, I would say, as you just did, right? Who's importing the most Russian gas so who's the most short? And that's probably a pretty good list to start from in terms of who will, be a Russian gas customer again, possibly in their own currency.
Yeah.
And then the other one is, I think, what I would say the two critical nations are the Germans and the Japanese, because they have had their current account surpluses tipped into deficit by the rising price of energy. And in plain English, that means they are on a short leash or a short path to a financial crisis, currency collapse, because they need those surpluses to basically finance fiscal deficits, and they don't have them anymore, right? So perfect example is Japan. Basically, the second they started running deficits for gas, yen has kept weakening and weakening and weakening, because they've got once Japan runs a twin deficit as opposed to a current account surplus, they've got to find someone to finance that twin deficit. Before, they were financing their fiscal deficits with their trade surplus. Now they're running a trade deficit and a fiscal deficit. They've got to go out into the open market and finance their deficits. Okay, they can't afford to finance their twin deficits at the global rate they would have to pay. It would bankrupt the nation by far. They would implode quickly. And that was always Kyle Bass's case on the yen, 6-10 years ago.
Right.
So Japan then has two choices. They can start selling down their foreign assets. They own, $3 trillion, give or take, of US dollar denominated assets, including $1 trillion foreign treasuries. And so it's been interesting to see the yen go, as the yen goes down, 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 which is up, up, up in the price of the, right, 135, 138, 130. 10-year treasury yield's gone right with it. It's been right. So that, there is selling of treasuries, it appears, by the Japanese to raise dollars to finance this now twin deficit. The other alternative is they can start buying energy in their own currency. They call up Putin. They say, listen, we'll buy it. We'll pay in yen.
Yeah.
You take yen, and then we will let you buy high quality Japanese made goods with that yen. It's a great deal for both. It's win-win. And the odd man out in that system is the dollar system. Now, again, there are macro geopolitical realities, not least of which is the U.S. military presence on the island of Japan, to that. And so I don't want to oversimplify it. But I think when you look at it two ways, who's been importing the most Russian gas to start with? That's one list. The other list, I think, are nations, and in particular, Germany, Japan. I would throw India on that list too. And there's obviously already signs that they are buying Russian energy in increasing amounts in their own currency, or are readying to, again, out of the realpolitik of they will have a currency crisis and economic collapse because of what rising energy prices have done to their balance of payments.
Quick break, then we'll get back to the interview. In the description of this video is a link where you can subscribe to my weekly newsletter. It's free and I love writing it. This week, for example, what I wrote about was a traditional role in society that we've lost, known as the sacred clown. In historic Lakota culture, for example, and many others, there is a role known as the Hayoka, and the Hayoka's purpose was to make fun of everybody and everything all the time, to prevent egos from running away or people taking themselves or their ideas too seriously. Now, we've lost that role in society today because those people get canceled, and that's a problem. So I write about things like this. I'd love to have you join the team. It's super fun. Link in the description. Now back to the interview. Enjoy. So what else does the U.S., I mean, you mentioned the macro geopolitical realities, right? There's more bullets in the chamber if you're the Fed or the United States, right? And it's not as simple as, oh, we can buy cheaper gas and food over there. Let's go over there, right? Right now, maybe the argument looks that simple and unappealing, in that, what does Russia offer you? What can the U.S. offer you right now? One is immediate relief of a crisis, and the other is more obscure, right? Sanctions and we'll fight inflation by reducing employment and yada, yada, yada. So what are those macro geopolitical realities? Yes, there's a strong military presence in Japan. Is that it? Is the hot war leverage, the real strong bullet in the chamber for the United States, Luke? Or what else is within their quiver?
No, I think there's the realpolitik of longstanding relationships at a personal level. There's longstanding trade relationships. There are protection relationships as it relates to China, the U.S. protecting Japan from China with a more belligerent China. So it is not that simple to just say, hey, they're going to go there. With that said, it depends how bad the situation gets. Once your domestic voters start to get cold, hungry, unemployed, every nation on the planet, it's going to be really, really hard to say in Japan, we need to increase unemployment and we need people to be cold because Putin is bad in the Ukraine 6,000 miles from here, and the United States is telling us not to do this. Mm-hmm. And that's not a, so some of it might come down to what is the election cadence in places like Japan and across Europe, which I'm not familiar with. That's not my area of expertise. But if there's no elections, then they can probably run on, the politicians can probably run on that platform for a bit, right? Yeah. Boris Johnson's already out of office, so he was out today or last week saying, you need to be cold to support, so we defeat Putin. Well, if he's out of office, he can say that all he wants. Let's see what the incoming prime minister says and how long, it takes for, whatever, the vote of no confidence or whatever. However, again, I don't know all the intricacies of British politics, but my point is that people are people. And you have little kids, you have a grandma, you don't want them cold for some ephemeral green / global policy issue 6,000 miles from where you sit. You don't care. Politics are local.
Yeah. And, we'll always be in a democratic country, I suppose. I wonder how much leaders like Xi Jinping and Putin kind of look at Western governments as just absolutely and necessarily flaky because they're always going to pander to their electorate on like a 4-year cycle. Whereas if you have solidified your position as the leader of a country, and I don't support dictatorships, but they're powerful for some reasons, right? One of which is they don't have insecurities about whether they're going to be in power next year or the year after that, right? And that gives them a lot of power, I suppose, and probably really affects the way they look at Western societies, and that, very short-term thinking, right? Our politicians will say what they need to say to keep their job, knowing that their job is up for grabs every 2 to 4 years. It's interesting.
Yeah, I think, what you frequently hear that the deal is in China that the Communist Party makes sure the economy grows and works, and the people defer on politics. They don't get involved with politics, and that's the deal. It's not a deal we understand as Westerners. It's not a deal I understand, but that's the deal. And I think if you strip that down, it's like they just want stuff to work.
Yeah.
Right. And so, and when you hear the Westerners say, well, if the economy stops growing in Japan or in China, that's going to create political legitimacy issues for the CCP, for Xi Jinping, et cetera. When you hear that, what you're really hearing is the Chinese people just want stuff to work. And you go to take this West now and go, like, if you don't have heat, if you can't make aluminum because you don't have the affordable electricity, because you don't have affordable gas, stuff's not working. Mm-hmm. And in that way, I don't know that the people are all that different, right? It's the citizens of every country just want stuff to work.
Yeah.
And, to your point, I mean, I think China has other issues, right? They got property stuff going on. They've got water issues. They've got, other issues. But I think what's happening with the power situation, with the heat, with energy is much more pregnant of an issue in the West. And I think it will become a political issue much more quickly.
So running through these scenarios, number one, what is expected to happen occurs. Europe ends up in an energy crisis. They can't afford to ship out any goods, leading to global inflation. Maybe number two, there's a bit of a rejuggling of the geopolitical map to an extent. Like, how do you position your portfolio? Like, what are you buying? What are you holding? To ensure that you've got enough insurance for whatever scenario unfolds over the next 5 to 10 years, knowing we don't know. Like, we can speculate all day long and it's fun, but we don't know what's going to happen. There's too many variables. So, what's your ballast? Like, what's in the portfolio that keeps you sane and helps you sleep at night?
Yeah, when you look out over an intermediate to longer term time horizon, I think you want to have more than usual cash. I think you want to have an overweight in energy, broadly defined. So it's probably oil, gas, uranium, maybe even some coal, maybe a small amount of alternatives. I think you want to own some gold. I think you want to own a little bit of Bitcoin. I think you want to maybe have some productive real estate, perhaps farmland, something that's an energy derivative, something like that. Niche real estate properties, right, that have some sort of finite uniqueness to them that aren't going to be rendered or haircut by either really expensive energy or Amazon or work from home. There's a number of different factors that could, take certain pieces of property and reduce their value non-linearly. And so I want to try to look ahead to those situations and avoid, right? So look, wealthy people are always going to have some money. They're always going to like going on vacation. They're always going to like going on vacation in pretty places, right? So, hey, lakefront property in British Columbia. Yeah, I'm sure it's expensive as heck. Like lakefront property is everywhere in North America right now, and I suspect the world. However, you buy something like that, rent it, some sort of that's a type of when I say unique real estate that has, you've got to take a pretty draconian view of the world to think that there's not going to be some interest in someone either renting it or whatever, things like that. So for me, it's this. I go back to, I've said this before in other interviews, a Jacob Fugger type portfolio. Jacob Fugger was said to be the richest man in the history of the world in terms of
that's right.
percentage. And, he said, look, 25% cash, 25% gold, 25% real estate, 25% stocks, right?
Yeah.
So I think, and then rebalance as you need to. So I think, and it's really about, there's so many things happening that has either never happened before or have not happened in a very long time, but have not happened at this scale, that I think it's very difficult to have high conviction and, hey, let's put all our money here or let's get really overweight here. I think you want to be across a number of things, but I do think if you're going to have a lean, it's a lean in secular inflation as you look out intermediate to long, 5 to 10 years. It's going to have to be secular inflation.
You think so?
I
And
do.
what kind of rates or increase would you expect, Luke? And what kind of time horizon, I guess, is a more important
Sure.
question.
Yeah, I think we've seen the local peak in inflation when July or whatever here in the United States, whatever it hit 9% or whatever. I think we'll see it tick down. I think we're probably going to get a whoosh down over the next 30 to 60 days in inflation and in markets, because I think the Fed's over tightening as we speak.
Yeah.
However, I think that is going to turn around, force them to basically reverse course, pivot with CPI still 4, 5, 6% headline. And I think we see double-digit inflation in the United States by this time next year. Probably towards the end of that 12-month period. I don't think we're going to go from 4, 5, 6 to 12 by January, but
Sure.
there's scenarios in which that could happen. I mean, if Europe does go boom and things just sort of supply chains break down, I think it's a layup to have double-digit inflation in the U.S. 6 months from now, 8 months from now. But I'm assuming just a normal steady state, things don't go boom. Just the fiscal situation of the U.S. government as reserve currency issuer, Fed's going to need to basically begin financing U.S. government deficits again due to the slowdown that we're already in, cutting receipts. You're going to, I think, see inflation in the 10, 12, 15% range in the United States, by this next time this year. And I think you'll run at that point for a while.
Okay. Interesting. And then, not having a thorough understanding of how the basket of CPI is created, there's inflation of discretionary items like maybe cars, you can buy an expensive car, a cheap car, all sorts of consumer goods. We saw a lot of discretionary goods inflation over the last 6 months. Those numbers seem to have come down, but the necessities, right, that we need in our life, those are still going up, or they've stayed high, right? And so when you forecast, a year down the road, would you put emphasis on those necessity goods inflation? Like, is that what you think will be hit with the hardest?
I do, because ultimately, I think the real bottleneck in this whole system at the moment is peak cheap energy. It basically, we can find and produce more energy, but it takes a steady increase in the price to do so.
So I've heard you say in the interview, if you're a billionaire, you go broke one of two ways. The first is war. The second is hyperinflation, right? I don't think you can call 15% hyperinflation. It's super high. Higher than I've ever seen, but it's all relative. I've also heard you say there are very few times in history where you want to own gold, but when those times occur, it's about all you want to own. And so, what would have to occur for us to get to a place like that? Can you see any threads that could get amplified and lead us to a situation like that?
Oh yeah, absolutely. I mean, look, China and U.S. go to war over Taiwan.
Yeah.
Global sovereign bond market is going to zero in real terms. Global sovereign, you're going to be talking about 120 trillion in bonds going to zero in real terms.
Yes.
And you're also going to be in a world where you're going to have widespread shortages. You would get borderline hyperinflation around the world due to the complexity of supply chains and the likelihood that China would either shut us off or we would blow up the factories in China that make this stuff for us.
Sure.
There would be no settlement of trade in IOUs in that situation. It would be payment in gold.
Right.
And to serve that role, gold would have to rise by a multiple where it is today. I think it's instructive. The last time the world was in a situation that I think is most similar to the one we're in now is probably pre-World War I, quite frankly, where you had this great power competition between the UK and Germany. I think very much analogs to today with the US and China. Post-World War I, 6 major industrial powers: US, UK, Japan, Germany, Russia, and France, they all saw the real value of their sovereign debt fall 75 to 100% against gold in the ensuing 12 years, from 1918 to 14 years, I guess, 1918 to 1933, right? When the U.S. finally devalued against gold massively. They were the last to do it. The Brits did it in 31. But the Germans, the Russians hyperinflated. I mean, their currencies went to zero against gold, basically. There were political issues there that I don't think are apples to apples, and that's always important to point out. But that's the kind of situation where, in that situation, anything that would be conflict related, those are the types of situations where, a lot of you're whatever percent you have in gold, you're going to want to have a pretty good allocation to physical gold.
And knowing that many people are watching those scenarios like you are, we're seeing maybe symptoms of an expectation of that. And maybe one would be, a shift from the paper gold market to the physical gold market, right? And I'm very curious how that could play out, right? I mean, almost everybody I know who buys or trades gold plays in the paper market. I don't. I like to own physical gold, and I don't know why. It just gives me some confidence, right? But I think I've heard you say as well, over the last 8 years, central banks have purchased 3 times more gold than US dollars. And there's been a big shift in the philosophy of what is, a sound money or a reserve currency or an insurance policy and all this. And would you expect that trend from investors away from the paper market, which is to say you kind of own gold, you own an option on gold versus actually taking possession? And if that trend were to really accelerate from central banks through to institutions, through to private investors like myself who want possession, could that put, immense pressure on the gold price that we haven't seen in 10, 20 years?
Yeah, I think the central banks, I think, are telling you sort of where this is ultimately going, but they are acting in sort of a glacial pace, right? They don't need to mark to market, and so I think over the since 2014, they've bought 270 billion in physical gold, and they've sold on net 200 billion in treasuries. So there's there's a serious shift going on. People say, oh, well, so it's only 200 billion, and they're right. Now, of course, central banks have a printing press, so they could revalue that gold anytime they want. You just add a zero to the end of it, and that 250 billion is now 2.5 trillion, and that's a little less so what, right? So now that's one way you could see gold go up. I think it would need to be again, there would have to be some sort of geopolitical catalyst or something. The other way, I think, to really get the physical market to separate from the paper market would have to probably be, again, related to the gold market being brought back in as a settlement mechanism for trade, and I think in particular for energy. And that's where I think partly what Russia has done over the last 10 years is so interesting by buying all these gold reserves. They're effectively swapping oil for gold, and the oil market globally at current prices is about 15 times the size of the physical gold market. And so, if there is a more explicit tie of the energy market to the gold market, that's where you would see the paper market, sort of the mythical paper market break, separation from physical. And that could be, hey, war, more sanctions, something where Russia just says, okay, we're done here. We value gold at, 200 barrels per ounce, 200 barrels of oil per ounce of gold. And, that would establish an arbitrage that would break paper markets instantly, right? Because then every Western paper trader could go, ooh, 200 barrels an ounce. It's only 20 barrels per ounce on the New York on the NYMEX COMEX NYMEX.
Yeah.
So I'm gonna go buy an ounce of gold on COMEX, and I'm gonna take delivery of the physical because Russia says only physical, and then I'm gonna sell it for 20 barrels of oil, and immediately the paper market will shut down because you'll clear out all the inventory like that. And that's I don't think the gold markets, I think it will trade with real rates in the short term. I think it sort of goes up with inflation and over time, but for sort of this phase shift that I do think will ultimately happen at some point, simply because I think gold is being brought back in as a trade settlement mechanism, because using sovereign debt of an insolvent sovereign as the world's primary reserve asset is a suboptimal system for pretty much everybody except the U.S. government, and that includes U.S. citizens. It's suboptimal for U.S. citizens as well.
Right.
I think it'll happen someday, but if it happened tomorrow, I wouldn't be surprised. If it happened in 10 years, I wouldn't be surprised.
Is there anything other than gold, Luke, that could operate as that settlement asset? Anything outside, any other alternative currency, basket of currencies, commodity backed, anything like that?
The problem with using useful commodities as a settlement asset is that you're going to starve people to death by using it, right? So let's just say instead of, we need a new settlement asset, and instead of gold, you've got to write it up a bunch, right, to make that settlement asset big enough to be liquid enough to serve in that capacity. So instead of writing gold up to 10,000 an ounce, in which case, nothing really happens. Nobody's short anything. A bunch of Indian housewives are a lot richer and whatever. Let's write up corn from $6 a bushel or $7 a bushel, wherever it's trading today. Let's write it up by, it probably needs more than 10x. Let's write it up by 20x. So now corn is $120 a bushel.
Yeah.
You're going to have 4 billion people, 10 billion, 4 billion, 6 billion people globally starved to death.
Yeah.
So that's the issue with using a productive commodity. Now, so then you say, all right, well, we don't want to use a productive commodity as a settlement asset in this sort of Bretton Woods 3 system, as to borrow the Zoltan phrase. And in that case, to me, Bitcoin works. It's a neutral reserve asset. It has an energy tie to it. It's finite. It's effectively a digital gold in my view. There are some others who would argue maybe other crypto could. I don't know well enough. I feel like I understand the structure of Bitcoin well enough to believe that, yeah, it could serve in that capacity. Beyond that, yeah, maybe some baskets of currencies, but I think that's the the problem with baskets of currencies is that someone has to run the deficits to supply the currencies, and none of the other parties want to do that because it's a threat to their national security, because you have to hollow out your manufacturing like the U.S. has done. So, the Europeans don't want to do that. The Japanese don't or can't. The British can't. The Chinese don't want to and can't if they want to keep their capital account open. So your options are really limited to a neutral reserve asset. And if you don't want to starve a bunch of people, limited to a quote unquote useless.
Yeah. That's such a fascinating argument because, I guess you could consider me a gold bug. I don't consider myself a gold bug. I do own gold, but I also own real estate, Bitcoin, cash, equities. I don't know if you call me any of those bugs, but it is what it is. But people who don't own gold, often their criticism of it, especially like the dogmatic Bitcoin crowd, points to it as, a useless rock, right? There's no utility. And the way you just described it, you're like, yeah, that's the point, right? If there was high utility, it could never be leveraged as a reserve currency because, whether you use corn as an example, but, put in copper, put in oil, like whatever, if you were to revalue that in order to serve that purpose, you would break the world, right? It just wouldn't work.
You're seeing that real time, right? I mean, we saw it in the 70s. I mean, that's effectively what the U.S. did, right? Oil went up 400% from October 73 to April 74. And we had gas lines and we had the inflation and oil was just being made big enough to back the dollar de facto. Now it would need to go up a lot more than 400% to serve that role this time, right? So, and that ties all of this saying, hey, well, gold's not used for anything. And that's the beauty of it. And it ties back to the point where you need to own gold like 1% of the time. And when it's that 1%, you want to own a lot of it. It's because what gold does is gold protects you when governments go bankrupt. Because when governments go bankrupt, they don't just go, oops, we don't have the money. When governments go bankrupt, their sovereign debt gets printed they print money to keep their sovereign debt nominally solvent. It's just what they do. And this is like, to me, it's one of the most fascinating things is, we wrote about this recently. If you go back, there's Reinhardt and Rogoff did some great work on sovereign debt crises going back, I think, 500 years. The book was called "It's Different This Time." The study was just different this time. A gentleman named Brian Hirschman at Hirschman Capital studied the data and goes, okay, if you go back 220 years to 1800, 98% of the countries that got debt to GDP to 130% defaulted. usually via high inflation, right? They print the money to keep themselves nominally solvent. 98%. In our business, 98% shots don't come around much.
Right.
And people say, well, what's the 2%? Well, it's Japan. Okay. People are like, well, we're going to be Japan. But of course, now look at what's happening to Japan today, right? It's oops, that it's catching up with them through the energy link. And so my point here is that people, the amount of hubris implied to say, well, it's different this time. This is going to be the first time in 220 years that our government is not going to print the money and cause it. Come on. Yeah. Paper gold markets have helped contain the price of gold. Bitcoin has done what you would expect gold to do without a paper gold market. It's, I think, why it's quite frankly wise to own both. So we'll see. But yeah, gold does nothing except do well when governments go broke.
Yes, I love that.
On a real basis.
Bitcoin has done what gold would have done, if there was no paper market. I mean, that's an interesting idea to think about, right?
Yep.
Yeah, fascinating. Now, what are your thoughts on some kind of a CBDC? I'd love to talk about this with you and get your thoughts on the, potential of, a CBDC that's rolled out that's aim is to replace the US dollar as the reserve currency. First of all, do you think this is something we could expect to see, Luke, in, a variety of ways over the next 5 years?
I think it's something we can expect to see. To me, it's horrifying.
Okay. Okay.
As a concept.
Why?
It's simply because of the potential for misuse and political control, right? We need to look no further than what Trudeau did with the trucker strike earlier this year.
Yeah.
They can shut down your bank account. It just is a very slippery slope. It would leave constitutional protections, et cetera, here in the U.S. doing an awful lot of heavy lifting to kind of protect civil rights. So that's why, I think you'll see it. I think the central bankers find it attractive because of the fineness with which they would be able to administer monetary policy, right? One of their problems is all their tools are pretty blunt right now, right? So right now, every time they loosen, rich people get a lot richer and poor people get poorer on a real basis because inflation goes up. And that's creating a political problem. And so I can see the attraction of it as a central banker, because I could say, all right, well, if with a CBDC, I can I can administer more money to everybody who makes less than, below the 50%, the median household income, and they can buy more stuff, and it equalizes income inequality, and it actually spurs economic growth more, and I can more fine tune that. And I get all of that. And I understand why they'd like that. And I think that makes sense in an academic vacuum. I think once that thing's let out into the real world, it's like, oh my God, horrifying, right? And I would encourage any central banker thinking about it to just, think about their political enemy having that power, and see if they still really wanted that, right? Their worst enemy having the ability to manage at that level. Do they really still think it's a good idea?
Which is something we do very poorly. Right. Even as citizens, right. Think about the tools you want to arm our politicians with. Well, what about when the team changes? Right. And suddenly it's like, well, wait a minute here.
Exactly.
I'm with you on that. That's the big threat with CBDCs. Initially I heard a lot of talk about the surveillance that could be accomplished and what a dystopian society this would create. And I get it, but I also kind of feel like that ship sailed a decade ago. If you're carrying a smartphone, it's all there already. Look at the scale of an app like TikTok. And, if you're using TikTok can see every app, every file within your phone, every keystroke, everything that's said within the proximity of your phone. It's all there already. So it's nothing new. I think surveillance, give it up. We gave that up a long time ago, but the autonomy we have over our money today still does exist. Just to a lesser or more extent. Canadian truckers is a horrifying example of precedent in my experience. We tend to look at events as like this thing that happened, but more importantly, it's like, what did that open the door to, right? And to just confiscate with zero warning the bank accounts of everybody down to like the 18-year-old who donated $20. Like, it wasn't like we're attacking political criminals here. It's just like blanket approach. We have the power to do this now. And it's always hardest the first time, right? It's
Yep.
always easier the second, third, fourth time.
Yep.
And, that's like a micro scale with Canadian citizens. We saw this obviously grand scale with the, US dollar reserves from Russia. And I think that's another interesting thread. But my only, I guess, like question about CBDCs would be the competency of the governments to actually execute a plan like this. If you think about like, what's that other technology that was super efficient and built out at massive scale, produced by a government? Like, oh, it's never ever happened for a reason, right? Like this stuff typically comes from private enterprise, private industry, right? And
I would argue, I may push back a little bit on that. Most of the time, I agree 100%, right? But I think there are things that are so expensive and so long that no private industry would withstand it or could afford to, right? So the Eisenhower highway system here in the U.S., right? That was a brilliant piece of governance. The internet. The internet would have died in the crib without DARPA basically supporting it, the U.S. Defense Department supporting it. So I think there are exceptions to the rule, but I would say by and large, your point stands of they tend to not be very good allocators of capital for things that are very productive. And they get very corrupted by just the way the system works, right? The corporate lobbying. I mean, the corporate lobbyists basically write all the laws now, so it sort of feeds on itself, at least here in the U.S.
Yeah. Having said that, I guess hurdle number one would be getting buy-in from the population, and I don't think that will be hard at all. Especially if the incentive is like, we'll put a bit of cash in your bank account tomorrow, right? And we're seeing 15% CPI. It's like, yeah, I'll take that money. So many people would, right? You look at the stimmy checks over the pandemic. Like, if the politicians stand up and say, this is new and people might be telling you it's scary, but here's what actually happens. We put cash in your bank account weekly, right? And yeah, there's some stuff here, but don't worry about that. Tomorrow you get paid, right? You'll get buy-in from the population. It's just going to happen, right? And
the last 20 years have taught me that the public will believe whatever they're told.
Yeah,
and it is what it is.
It is what it is, especially since there's been, I guess at this point, a 14-year training program on operating a digital currency, right? Like, people become more and more comfortable with this concept and technology.
Absolutely, that's a great point.
One of my guests, Lynette Zhang, she speculates that it's been the Fed that's been behind Bitcoin the entire time as a training protocol to warm people up to the idea of a digital currency if and when they want to roll out their own central bank issued digital currency. I thought it's a fascinating,
it's interesting.
Fascinating speculation. All right, Luke, I want to point people to Forest for the Trees. I'm just going to say, like, it's one of the most valuable pieces of research available. You publish weekly. It's 20 pages of awesome insight. You do a great job at distilling pretty, complex and technical articles into street talk, so folks like me can wrap my mind around these concepts. And it's like cheaper than a bus pass. I mean, the price point's ridiculous. So I want to point people to it's FFTT-LLC.com.
Yep. Yeah. FFTT-LLC.com. And yeah, you can find out more about our mass market and institutional product offerings there.
Yeah, I'm sure you got a lot more. And super active on Twitter. You can find Luke there. But look, man, it's been a pleasure. Thanks so much for coming back on the show.
Thanks for having me back on. It was great catching up.
All right, thank you for watching this interview. Now, 3 things before I let you go. Number 1, I publish a weekly newsletter and I love writing it. I share my biggest takeaways and action items from the conversations that I have on this channel. In addition, my thoughts on current events, economic events, political events, and you can subscribe for free. Just hit the pinned comment right beneath this video, or just go to jmartin.club and you can subscribe on the website. I'd love to have you join the team. Number 2, ad revenue from this channel is donated to an organization that is super close to my heart called Zero Ceiling. Now, Zero Ceiling's mission is to end youth homelessness, and the way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then provide them with supportive housing, career training, and just generally positive influences on their life. I love what they do. Check them out if you're interested. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcasts. Just search for The Jay Martin Show. All right, thanks again.